How would you characterize, Monica, what's happening out there? And welcome to the program.
Hi, thank you for having me. Yeah, I mean, I think that despite, the concerns about the virus, the vaccination rollout, we do think that the Asia credit will remain pretty resilient. So, we still have a fairly positive outlook overall.
Okay, I mean, a lot of people are anticipating that this dollar weakness will continue into next year. We've got a couple of people who've been contrarian on that. Where do you sit, and how does it impact credit markets, of course, dollar credit markets in this part of the world?
So we still think that dollar will stay in lower range, but we don't expect it to be any drastic weakening. Overall, with the dollar staying in a lower range, that will be supportive for our EM markets. I think for our credit markets, we think that because the valuation is so cheap, the dollar weakening isn't going to weaken overall support for dollar bonds in our markets.
But Monica, there are views out there suggesting that Janet Yellen will be under a lot of pressure to have a strong dollar given the impact on the U.S. current account.
Well, I mean, I think that given the current wave of the continued fiscal stimulus, and we don't think that the dovishness of the Fed is going to change. I think that will still contain the dollar. So we're not very concerned about that. We do think a secular recovery will continue to be supportive of credit markets.
Monica, as investors continue to hunt for yields, Asian junk bonds, are they a must-have for 2021?
Well, we have been pounding the table about Asia junk bonds. I think junk gives it a negative connotation, but actually the single B space in Asia credit is just incredibly cheap right now. Our single Bs are paying over 3% more than U.S. similar bonds, and there's a lot of room for compression, not only against U.S. high yield, but also EM as well. In particular, I would say that it's not just, it's cheap in absolute terms and relative terms, but also against the fundamentals, which, we see that fundamentals, we have passed the worst of the ratings downgrade pressures in Asia credit. And if you look at credit metrics, both in liquidity metrics as well as debt service coverage, in fact, debt service coverage for Asia high yield has actually incrementally improved, although there's some slight deterioration in net leverage. But overall, relative to the fundamentals, it is for us, the single B space is incredibly cheap. We also see that the markets are technically supportive. There's continued to be strong inflow from local investors. Retail has excess cash. Asia banks have strong deposit growth. And will be seeking yield, and insurance companies still need to match assets against liabilities. So there's strong demand from locals, and I think that the allocators abroad are seeing the juice now in Asia credit as well, and that's going to move the needle there also. On the supply side, we have had a strong year this year of supply, despite all that happened. We're going to end this year at probably over 320 billion of additional bonds in gross issuance. The next year, we expect gross issuance to rise to about 340 billion, but actually net bond stock will be lower because of the high amount of redemptions and early buybacks by many issuers. So if you look at the increased demand against, relatively tame net supply, especially in high yield, because I think we expect most of the supply next year to be coming from investment grade. Net, I think this is really the place to be across global credit markets.
Monica, last question to you. What other headwinds going into 2021, and how concerned are you about defaults, particularly in China?
Yeah, I mean, let's go through the question on defaults first. This year we actually ended up better in percentage of default than I had expected at the worst of times this year. We ended up at just around 3.5% in default rate this year for offshore markets, and that's relatively tame considering all that happened compared especially to the U.S., which is expected to end up almost double that in default rate. And onshore, interestingly, the number of issuers defaulting onshore came down from 42 last year in terms of number of issuers to around 27 this year. So on average, last year we saw around 3 to 4 issuers per month defaulting. This year it's now trickled down to 1 to 2 per month. And the key observation I would make is that 5 defaulted companies made up of over 50% of the notional bond defaults. So we're seeing that defaults are more concentrated in larger state-owned firms rather than spread across private companies. So, that still means that, there is I think we're seeing still a trend of a recovery across most the private sector. I think next year we're going to see global default rates, normalize, but China may actually see default rates come down only marginally, just because I think they're going to allow market mechanisms to take hold, and the weaker and the less strategic ones will continue to face some default pressures, which I don't think is an unhealthy thing. As far as the top risks, obviously there's the risk of the vaccination rollout, whether that's successful to contain COVID, but that's well flagged. I think for us, one of the key factors is that this year, obviously everybody benefited from loosening monetary policies. We will see, continued fiscal stimulus, but next year I think we have to be concerned if inflation expectations suddenly shoot up, and if that causes a quick steepening of rate curve, then that will affect credit. However, for our strategies, we're largely hedging for rates. So credit spreads, might be volatile, but we still believe that credit spreads itself will end up tightening by end of next year. As far as geopolitical risks, I think we are still concerned about how U.S. and China may or may not improve relationship under Biden. We've seen increased antagonism, not only over, the handling of the coronavirus and position of national security law in Hong Kong, but of course, recently there's been the blacklist over more number of companies with China military ties. I think increasing tensions in South China Sea and any tensions over the status of Taiwan, like these items, I think will still linger, and we'll have to see how Biden resolves that.